What to do, Airheads? Air here, back for another rip in our TA series. If you are a newer or intermediate even trader and you are stalling out, you're not winning trades, your portfolio is not growing, this is not only a good series, but this particular video will be pretty good for you. We're going to be talking about stop losses, entries, position sizing, how much money should you be trading if you're new or intermediate to this. A few things also we're going to throw in there, some leverage talk, and talking about trading ranges, stuff like that. It's going to be a pretty short, to the point video. That's what I'm trying to do here. But if this is the first time you've ever seen my face, hit that playlist in the description below. Start at video number 1. Work yourself through this series. Start there. The first video is about expectations. If you don't have the proper expectations going into trading, you're going to fail. If you're just throwing yourself to the wolves, like I did when I first started, it's going to be a longer journey. So help a brother out, smash that thumbs up button, comment down below, turn on notifications. And if at the end of this video you find this content helpful to you and you want to see more like this, or you want to join a live stream every day where we dissect the markets, you want to get it on the ground floor of a growing community, hop in Discord, discord.gg/Alpha Aere, and let's just get into the video. Enough rambling. Let's start this off with a quote from Aristotle. Knowing yourself is the beginning of all wisdom. And let's be honest, humans, we're bad at predicting what can happen in advance to any certain set of given conditions. We have egos, we have big heads. We need to ask people close to us, your spouse, your friends, what your risk tolerance might be, how they perceive you. You might think you're the most risk tolerant person out there. You might think that you're comfortable with risk, but your spouse or a close friend might see something different in you. Financial advisors, properly trained, experienced financial advisors, are trained to help assess risk. That is the first thing they're going to, maybe not the first thing, but it's one of the first things they're going to cover with you and try to figure out your risk assessment. That's how important this is. As a trader, we have to identify if our decisions are from the heart or from the head. Are they emotional or are they well thought out? I have ego issues. Everyone does. Now, when you involve people who are close to you in this process, like I've involved my wife and my friends, they pointed out some things in me that I didn't see in myself that helped me develop my trading plan. So it's important to involve these people. I don't know that you necessarily need to go to a financial advisor, but if you can afford it and you want to, by all means. I'm speaking about this because risk to reward ratio is an important step in your trading career. A lot of people get this wrong at the beginning. They throw $1,000 into a trading account and they use that whole $1,000. They're using 20, 30, 40, 50, 60 times leverage, and they're losing that money consistently. The easy part is the technical analysis. It took me a couple months to figure that part out. The harder part is the mental aspect. The psychology of trading is the harder part. Having the discipline, having the patience to wait for the price to come to you is the harder part. This is the part that people fail at. This is the part that 95% of people fail. We talked about this in the first video, right? 95, 98% of traders fail. It's just that statistically, the odds are stacked against you. And that is simply because people have demons. There's psychology issues, right? It's just like gambling addicts or a drug addict or anything else. You want that dopamine hit. You want to get in on the trade quickly. But the reason that these 95, 98% of traders fail is the mental aspect of trading. The easiest way to mitigate losses is to have a low risk tolerance, is to have low leverage, is to have more patience, take less trades, is to get better entries, to trade the top and the bottom of ranges, is to not trade with that much money. So let's knock out the first topic, right? I bet you none of you guys are doing this. I bet you. So the 1% rule. This is a widely accepted rule. The 1% rule demands that traders should never risk more than 1% of their total account value on a single trade. For example, if you have $10,000 on a Binance or MEXC or KuCoin account, that doesn't mean you can only invest $100. It means you shouldn't lose more than $100 on a single trade. The main motivation behind this 1% rule is protection. By risking only 1%, you need to lose 100 trades in a row to wipe out your account. Stop losses are orders that close an open trade automatically after the price hits a specific level. Stop losses are used to limit losses in trading and play an important role in the 1% rule. So if you're not doing this, if you have $1,000 in your account, $1,000, you should lose no more than $10 per trade. This is a trading idea, philosophy going way back. Don't fight the system. If you're new, stick to that 1% loss. So your stop loss needs to be no more than on a $1,000 account, $10. On a $10,000 account, $100. Most of you I know, just from statistics, are not going to listen to me, are not going to take this advice. You don't have the discipline. You just don't. Most of you are going to fail out. You're not going to make it past 3 months, past 6 months, past a year. That's just statistics. And I say this not to disparage you, but just to set expectations. Hedge funds, trillions of dollars of assets under management hedge funds, use that 1% rule, and oftentimes much less. So why do you think you're smarter than hedge funds who have trillions of dollars under management? What makes you smarter than these hedge funds? Let's talk about position sizing a little bit here, because it can mean two things. How much you're willing to lose. So that is the 1% rule. You should never risk more than $100, 1%, on your account, which in the case of, I just loaded up this account with $10,000, nice easy round number to do the math. Don't have to think too hard, but you can switch the stop loss to price, ROE, and P&L. Switch it to P&L, right? How much you're going to risk, how much money, how much of that $10,000 are you going to risk? So the first thing I would say here is it's subjective. So the 1% rule doesn't mean you only risk $100. You can risk all $10,000 of it. If you're super highly confident, which if you're a new trader, I don't know how you can be, but if you are, in my case, there's certain trades where I'm risking 100% of my account value, but I'm still not risking more than 1 to 3%. So I'm increasing my risk assessment because I'm a better trader. I do this for a living. I'm in the profit. However, if I'm less confident, maybe I'll do 25%. Maybe I'll do 10% of my account value. Maybe I'll enter multiple trades because it's a crazy day and I'm seeing multiple things. So if we are risking 25%, I still don't want to lose more than 1% of my account portfolio. So I'm going to type in minus $100 right there. There's your stop loss trigger price, right? 27,251. 27,251. Mark that out on your chart. Is that where you need to be for a stop loss to enter into your position? If the answer is yes, take that trade. I use the 1% rule. Sometimes I increase my risk depending on the position, depending on where I enter, and depending on my confidence level of the trade. But as a new trader, you need to stick to that 1% rule. On $10,000, you don't want to lose more than $100 as an example. When you're talking about the actual position size, meaning how much money are you going to invest in each trade, that's subjective. How confident are you in that trade? If you're not very confident, do 10%, do 20%, do 25, 30, 40, 50%, depending on how confident you are in that trade. While keeping in mind, you're still not going to risk more than 1% of your portfolio. If you lose a trade and you lose $100, you're now down to $9,990. So 10% of that is whatever that is, right? My brain's not working this morning. I haven't woken up yet. But if you go down to $9,000, you don't want to lose more than 1% of that. So that's $90 now. So you will get your stop loss based on the 1% rule. You will know where your stop loss needs to be when you enter it in. So if you have $10,000 into an account, 1% of that is $100. You enter minus 100. You change this to P&L, right? Look on my screen right here. You change that to P&L from price. And you put in minus $100. If your account value is at $8,000, let's say it's you've lost a few trades, right? It's down to $8,000. Let's just say that's $80 stop loss. That'll tell you your stop loss needs to be 27,181.8. Then what you do, you mark out that stop loss, that 27,180, which we got from right here, 27,180. Actually, let's change it because there's $10,000 into this account. So let's make it 100. So 27, it's the same, 27,180. So 27,180. Am I going to take this trade right now? Well, no, for multiple reasons. Number one, we're in the middle of a range. 27,180. Like I can go, this is a 30-minute chart. I can go like 2 candles back and see it wicked us out of there. It wicked us out of here, here, here. That's not a good entry. I'm not taking that trade. You'd be a fool to take this trade right now. Unless you're more experienced, your risk tolerance is better. But right now, starting off, you don't take this trade. And that is on 10 times leverage, which is high leverage. You're 10 timesing your money, meaning that stop loss is going to come 10 times faster in theory, right? When you're first starting off, you need to be using low leverage. As a new trader, we're sticking to that 1% rule, right? We're analyzing our actual capital position size based off of how confident we are in the trade. But, you know, to tie it back into that starting off mental aspect or starting over, if you're starting over because you lost, it's that risk ratio. You need to start low. And really, I would work my way up from 1%. I know none of you are going to do that. You're just not. So do 5%, right? Do 5%. Change it to 5%, and you can see that change, 27,215. Now, I got an extra $100 on my stop loss. That is huge. Do that for 30 days. Stick to 5 and under for 30 days. If at the end of that 30 days, you are profitable, if you go to your account P&L and you are in the green, up it. Go to 7%. Go to 8%. Stick to that for another 30 days. If you go back down, if you start losing money over those 30 days, go back to 5%. Go right back to 5% until you get better. As you get better, that is when you increase your risk. That's when you do things like increase your stop losses, your position sizes. Until then, though, all you're going to do is lose money quicker, get frustrated, and then your dream of becoming a trader is out the window. And let me tell you, right? The nice thing about becoming a trader, right, is in most cases, you make money. You make a shitload of money. But more important than that, the time that I get with my family and my friends, the time that I get to go do what I want when I want, that's more valuable to me than the actual money itself, is the time aspect, the freeing up of time. I can't stress this enough. I know there's people out there. I know I post 20 times. I don't go over 20 times, but I know there's people out there who do 40, 50, 60, 70 times trades. I'm here to tell you that those people aren't risking a lot of capital. It looks cool, right? When they show their MEXC or Bybit or BitGet or whatever, P&L wins like 50 times. They're up 1,300%. That's on 10 or 20 bucks. Let's be honest. They're not risking a lot of money. No trader out there is taking $100,000 and doing 100 times leverage on it. That's ridiculous. There's no one out there who's doing that. So listen to me or don't listen to Air, but your risk needs to be low to start. Otherwise, I've seen this personally happen so many times. You're going to get burnt out and you're done. Then you're still in your 9-to-5 wage slave job. Your goal of becoming a trader is out the window. Start with low risk tolerance. Work your way up. It's easy for traders, and I'm guilty of this too, just to oversimplify things and be like, you need to do this, and that, and they draw some stuff out and tell you about 1%. But at the end of the day, we get jaded because we are better traders. We don't think about what it used to be like when we first started off. So I'm here to tell you, start with low risk tolerance, low leverage, 5 and under. Start with that 1% rule. Don't lose more than 1% of your account. I still use that. $1 trillion hedge funds still use that. So why aren't you? Let's talk about entries a little bit here. So I have 3 lines because I just drew this one, which is my stop loss. So let me get rid of that one. I'm going to keep that quote on there, baby. But 27.5 right now, 26.8 right now, 26.8 right now. I can throw 27 on there now because that's come in thicker, but 27.5. Let's throw a 27 on there too. 27,000 right there, Alt H. There's your support and resistance levels. This is where you enter trades. You don't enter trades in the middle of a channel. You just don't, especially starting off. You enter trades off of support and resistance levels, off the top and the bottom of ranges. If we come down here to 27, you're thinking to yourself, good long opportunity here. That doesn't mean you set a limit order for 27K and you automatically long it because there's a possibility that we crash right through it. You got to watch it. But what I do typically for entries, right? If I'm not at the computer, because I often am, because this is my job, I'll set another horizontal line right there, right click it, double click it or right click it, whatever, right click it, add an alert on it. Boom. When the price crosses below this, I'm gonna get an alert on my phone, on my computer, wherever I am, to signify that we're coming close to this $27,000 level that I need to start watching for an entry. Doesn't mean I'm gonna automatically enter into an entry, right? This is how I do it. You do it however you want. I'm sure people have different strategies, but I wait to see what it does here. Are we gonna get a solid bounce, or are we gonna lose it, retest it, and lose it? You gotta watch. And if we are in the middle of the range here, you wait. That's what we say by waiting for the price action to come to you. Your positions, you enter off of these support and resistance levels, right? You wait, and we might not hit it all the way. You got to make a judgment there, but you don't want to enter there. Smart money is entering here, right? Smart money entering here, right? It's going to touch it. 1, 2, 3, 4, 5, 6 opportunities for long positions here. It's going to come to you. The price is going to come to you. And there's lots of ways. I'm not going to go over all the ways to come to these levels. I mean, you can use the fixed range volume profile, drag it across there. You can see your POC, your value area high, your POC, your value area low there, which corresponds with that $27,000 level. Now, this range is a little crazy right now. This isn't a great example. This is the day of the FOMC meeting, so price is kind of all over the place right now. Not a good example, but I think my point is coming across nicely. Is you want to enter off the top and the bottom of ranges, wherever that might be, right? I mean, you can draw them out. There's the top of that range. There's the top of that range. There's a good top there to be watching for. So you just look at the previous levels that we've been at, have a shitload of lines on your chart. That's fine. But when we approach them, you can watch them for potential breakthroughs or reversals. And it's the same. It's the exact same when you're watching chart patterns. I mean, this is a pretty crappy bull flag, right? But let's just roll with it. I mean, we're in the middle of the range, but we're approaching the top of the range. You can see we touched it today and then we bounced down, right? Touch the top of the range, bounce down. Touch the top of the range, bounce down. Bottom of the range, bounced up. Bottom of the range, bounced up. Bottom of the range, bounced up. Smart money takes positions on the bottom of ranges and on the top of ranges. The dumb money, and that's retail, guys, believe it or not, these hedge funds call you dumb money because you're swimming around. The minnows are swimming around in the middle of the range, and these killer whales are just gobbling you up. Let's give one more entry example here. Let's just say, for example, the price is making a run up today. We're coming up to that $27,500 level right now. You get that bounce down, retest, and you're like, this thing's not going to crash through. Not enough momentum right now. You're looking at other indicators. You say to yourself, I'm going to enter into a short position here off the top of the range. The momentum is just not there. And let's just say you're pretty confident about that, right? So, well, how do you figure out what your stop loss is and your position size? Well, it's going to be based on that 1% rule, right? So you want your 1% rule, $100 off of $10,000, $10 off of $1,000. So how much money do you invest? Well, you can see I got my P&L, so I don't want to lose more than 1% of my total account value, $10,000, which is $100. So when I slide this max openable quantity, meaning how much of the money, right? So 20% would be $2,000. My estimated P&L rate is minus 5%. My P&L should be 27,403. So 5% is my stop loss here. So let's go to, right? 5%. So 27,414. So that's pretty good on 5, right? So let's go up 5% to figure out where the stop loss is going to be on this trade. I mean, it would be 1%, right? It'd be 1% because it's a 5 times leverage. So 1%, boom, right there. So this is where your stop loss is going to be. You're right here. That's where your stop loss is going to be. Is that a good trade? Well, aside from this grayscale lawsuit win we got back here, yeah, there's been no candles above here. So I'm going to take this trade. I'm going to take this short. I know where my position needs to be. based off of the 1% rule. It tells you right down here when you enter in minus $100 where you need to be. I don't know if you can see this, but when I slide it to more money, right? When I use more money, my stop loss comes down. So does my P&L rate. I'm now down to 2.5, 2.2, 1.8, all the way up to a 1%. So that's $50 at the current price, which Bitcoin is at right now. The price on a short the price can only go up $50 before I'm stomped out. That's not a trade I'm going to take. I'm not going to bet my whole account based off of that. I'm just not. I'm going to bet probably 20 to 30% of my account so I can get a 5% stop loss. I'm more comfortable with that. My stop loss percentage, 3 to 7%. No more than that is where I'm comfortable with. But keeping in mind the 1% of your total account value rule. So if that doesn't make sense, you kind of just play around this a little bit. But the more capital I use, right, the quicker to that minus $100 I get. Same thing with leverage. The more leverage I use, the quicker to that minus $100 stop loss I get. I'm going to do a quick wrap up for you guys. So everything we talked about today is a risk reward ratio, is a risk assessment. We talked about the 1% rule. You do not want to gamble more than 1% of your total account value on any given trade, right? If you're in multiple trades, you got to take that in consideration. So on $1,000, you don't want to lose more than $10. That is the 1% rule. On $10,000, it's $100. That is your stop loss. That's the P&L of your stop loss. You don't move it. If you get stomped out, you then go back to the drawing board and figure out what the hell you did wrong. You didn't get a good entry. You didn't wait. Something happened. You got to go back, replay it, and figure that out. We talked about position sizing a bunch, the actual position sizes. As you use more capital, keeping in mind that 1% rule, as you use more, you get to that stop loss a lot quicker. We talked about leverage and how important it is to use low leverage when you're starting off and then adjust it like every 30 days or so to more. You can use more leverage if you're winning, right? But then if you start losing again, you got to go back. Use low leverage. We talked about taking entries off of support and resistance, range highs, range lows, not in the middle of the range. So the question is, well, how come, if it's this simple, 98% of traders lose? Well, it's because the mental aspect of this game, tying it all back to the beginning, is not. And that is the hard part. Most people load up $500, $1,000, $10,000, $20,000 into account, are throwing in 20 times, 30 times leverage because they will think they're going to get rich overnight. And I'm here to tell you that statistically speaking, 98%, 95% of traders fail. So statistically speaking, it's not going to happen for you. Statistically speaking, you are going to fail. But when you do these things that we talked about, when you get your mental aspect in check, the discipline in check, when you do the 1% rule, the position sizing, the stop losses, the leverage, the entries, you're going to succeed. If you can master those, I'm telling you the TA is easy. I promise you it is. If it's hard for you, then you're overthinking it and you have too many indicators. You're thinking way too hard about this. TA is easy. It's the mental game, the mental aspect of this that is hard. If you can do all these things I talked about in this video, in the previous videos, you're well on your way to becoming a better trader. But if you're just pissing money away, if you're using 20, 30, 40, 50 times leverage, if you're not setting your stop losses, if you're, not doing the 1% rule, you're gambling. You're not trading. You're a gambler at that point. Stop it. Get back to the basics. Follow these rules and you'll become a better trader. Thank you guys for watching. 25 minute video here. I appreciate you guys. If you like this, please hop in Discord. Give me a chance. Discord.gg/Alpha Aere. Come join. Come hang out. Looking to make some buddies over there. Appreciate you guys for watching. I'll be back for more videos. I finally got my setup working again, so it feels good. If this sounds weird, video sounds weird or anything, let me know. But that's it for today's video. Appreciate you guys. I am out.